Isabel and Ryan just got pre-approved for a $500,000 house. The letter is on the table. The bank said yes. What the bank did not tell them, the math breaks by month 8. This is the qualification gap, the distance between what a lender approves and what a household can actually carry. For most buyers at this price point in 2026, those two numbers are not the same, and the gap between them is not a rounding error. It is the difference between building equity and watching it evaporate while the furnace makes a noise it didn't make in October. The qualification gap is not a rare edge case. It is the default experience for buyers who run the first calculation and skip the second one. And the second one is the only one that matters. Here is what the real number looks like. At 7% interest, which is where rates are sitting for most buyers today, somewhere between 6.5% and 7.5%. A $500,000 home with 20% down means you are financing $400,000. Your principal and interest payment is $2,661 a month. That is not your payment. That is where your payment starts. Add property taxes. The national average effective rate is 1.1% of assessed value. On a $500,000 home, that is $5,500 a year, or $458 a month. Add homeowners insurance, typically $1,500 to $2,000 a year. Call it $150 a month to be conservative. You are at $3,270 a month before a single piece of furniture is inside. And that number assumes 20% down. If you put 10% down, your loan is $450,000, and the bank adds PMY, private mortgage insurance, an invisible tax for not having enough saved. PMI runs 0.5% to 1% of the loan annually. On a $450,000 loan, that is $225 to $375 a month. Your payment climbs toward $3,500, $3,600, sometimes higher. Some neighborhoods add HOA fees on top of that, $200 to $800 a month for amenities you will use 4 times. That pool looks very different in February. The annual cost of simply owning the house, before utilities, before maintenance, before anything breaks, is $39,240 a year. That number does not appear in the listing. Geography changes the math entirely before income even enters the picture. In San Jose, $500,000 gets you a 2-bedroom condo and a commute. In Austin, it is the median. Nothing exceptional, nothing wrong. In Cleveland, it buys a house with a yard, a garage, and 4 bedrooms in a neighborhood with actual trees. Same number. 3 different realities. The monthly cost compounds the difference. New Jersey has an average property tax rate of 2.2%. Hawaii averages 0.3%. On a $500,000 home, that is the difference between $11,000 a year and $1,500 a year in property taxes alone. In New Jersey, your monthly payment before insurance clears $3,700. In Hawaii, that same mortgage costs $2,785 a month. Texas and Florida charge 0 state income tax. California charges over 13%. The same $140,000 income produces meaningfully different take-home pay depending on which side of a state line you are standing on. The mortgage payment is the same. The life around it is not. Which brings the qualification gap into sharper focus. Lenders use a framework called the 28-36 rule. Your housing payment should not exceed 28% of your gross monthly income. Your total debt, housing, car payments, student loans, credit cards, should not exceed 36%. At $3,270 a month, the 28% rule requires a gross monthly income of $11,680. That is $140,000 a year. The median American household income in 2026 is $80,000. At $80,000 gross, your take-home in a moderate tax state is somewhere between $5,400 and $5,800 a month. Your $3,270 housing payment is 56% to 60% of everything coming in. The 28% rule does not exist for you at this price point. The math removed it. The household income that actually makes this work, without financial stress eating the first 3 years, is $120,000 to $160,000. That puts you in the top 20% of American earners. 80% of the country cannot make this math function at current rates. That is not a moral judgment. That is the arithmetic. Now the down payment. 20% down on $500,000 is $100,000 in cash, not invested, not in your 401k liquid, available, gone on closing day. Add closing costs, typically 2% to 5% of the purchase price, around $10,000 on this deal. And you need $110,000 saved before you walk into that closing room. The median American household saves 4.5% of income. On a $100,000 household income, that is $4,500 a year. At that rate, saving $100,000 takes 22 years. 22 years. That number sits differently once you say it out loud. Most buyers in their late 20s or early 30s are not doing that math. They are looking at the pre-approval letter and doing a different calculation entirely, one that starts with "we qualify" and ends with a moving date. There are shortcuts. FHA loans allow 3.5% down, $17,500 on a $500,000 home. But FHA adds PMI for the life of the loan on low down payments, and your monthly payment climbs accordingly. Federal Reserve data indicates that buyers with parental financial assistance are substantially more likely to purchase in high-cost markets than buyers without it. The down payment is not just a savings problem. For many buyers, it is a generational wealth problem dressed as a savings discipline problem. The qualification gap starts here, long before the broker's office. Then there is the debt-to-income trap, which catches high earners who never see it coming. A household earning $150,000 a year has $12,500 in gross monthly income. They should qualify easily, but add a $650 car payment, $800 in student loans, and $200 in credit card minimums. That is $1,650 in existing monthly debt. Add the $3,270 housing payment. Total, $4,920 a month. DTI, 39%. Conventional lenders cap total DTI at 43% to 45%. The 39% gets approved, barely, with almost no margin for anything else. One unexpected expense, one income dip, one car repair, and the math breaks. Paying off that $650 car payment before applying increases qualifying loan amount by $100,000 or more. The sequence matters more than the income. The DTI trap is where the qualification gap does its most damage. The approval letter never shows it. The closing table never mentions it. It surfaces in month 8, when the numbers stop working and there is nothing left to cut. The credit score dimension closes the picture, and it is the one most buyers walk past without stopping. A 620 credit score and a 760 credit score do not get you the same mortgage. The 760 qualifies at approximately 6%, a $2,398 monthly payment, $463,000 in total interest over 30 years. The 620 qualifies at approximately 7.5%, a $2,797 monthly payment, $607,000 in total interest. The gap between those two credit scores costs $144,000 over the life of the loan. A credit score below 700 is a signal, not a permanent disqualification, but a reason to pause the house search and run a 12 to 18-month improvement window first. Keep revolving balances below 30%. Do not open new accounts. Let the on-time payment history accumulate. The improvement window feels slow. The $144,000 does not. Here's the buyer profile that actually works. Household income at $130,000 or above. Total existing monthly debt under $500. Credit score 720 or higher. Saved cash between $80,000 and $110,000, which covers the down payment, closing costs, and 3 to 6 months of expenses retained after closing. Not cleaned out on day one. That profile exists. It is uncommon. The majority of people sitting in a broker's office do not check all 4 boxes on the same day. But the buyers who match it, the ones who ran the 12-month improvement window on their credit score, paid down the car loan first, watched the down payment account grow past the closing cost line. Those buyers are not guessing on signing day. They know the number. They have already closed the qualification gap on paper before they close on the house. The buyers who match it, the ones who waited 18 months longer than felt comfortable, they own the house for 15 years without regret. The discipline that built the savings redirects directly into the brokerage account. The version that ends badly is the one where Isabel and Ryan sign because the bank said yes, and spend the next 5 years watching the equity they built slowly buy them less freedom than the rent they escaped. Equity on paper, zero flexibility in practice, and a creeping awareness that the house owns them more than they own it. The version that ends well is slower, less exciting on the day of signing, dramatically better by year 5. Month 8 is when buyers who bought on optimism alone usually discover what the real number feels like, not month 1, when everything is fresh. Month 8, when the emergency fund is thinner than expected and the furnace makes a noise it did not make in October. The buyers who ran the full math before signing, who stress-tested the monthly number, who knew the DTI before walking in, who had the credit score window behind them, those buyers do not get surprised in month 8. They already lived that scenario on a spreadsheet. They had already closed the qualification gap before they opened the front door. Run 4 numbers before you walk into the broker's office. Housing payment against 28% of your gross monthly income. Total DTI with every existing payment added in. Cash remaining after closing day, not before. And your actual credit score against the rate tier you will qualify for, not the rate you have seen advertised. That exercise fits on one page. It takes 30 minutes. It tells you whether you are ready before the bank weighs in, or whether you have a 12-month window to close the gap first. The buyers who did that work are not surprised in month 8. The ones who skipped it usually are. The variable that moves the DTI calculation more than any other is the debt payment. And most people have never calculated what their current debt is actually costing them once interest compounds over time. That number changes what to pay off before you apply. And by how much? That video is next.